Great.
Hello
Dave?
and greetings to everyone who's joined us today. We're really happy to have you here. Welcome to 2022. Happy New Year. We've organized this today around what we're calling three big questions, just three topical areas that we knew we wanted to touch on no matter what. But we're really, as always, hoping that this will be highly interactive. Obviously, we've been in the midst of a very interesting 2 years. The pandemic has changed the way we view everything, including financial planning, the markets, the economy. I mean, the fundamentals still apply, but the particulars have sure been unique. And so we'll be talking about both of those things today. We'll be talking about the fundamentals that haven't changed and that probably won't change, but we'll also be burrowing into the particulars because we know that's what's on your mind and that's what's in your newspaper and on your television every day. And what's going to happen is that Lauren and Yusuf are going to take the lead on some of these big questions regarding the economy, the markets, what's happening legislatively. I'm going to be mostly color commentary, but you all know me. That means I'm going to be talking a lot. But the three of us are all going to be diving in on all of these questions and all of these issues. But what we really hope is that you take advantage of the chat section. There is, if you look at the bottom where you'll see a set of bubbles that you can click on, and it gives you the opportunity to post your questions to the chat area, and we will be monitoring those closely. And so no question will go unanswered. And we're hoping there are a lot of them because it's always more fun when it's a bit of a dialogue. So with that,
Dave,
yes.
Just on that note, there's also a Q&A bubble at the bottom, so you can post your questions in the chat or the Q&A, and we'll be monitoring both.
Very good point. Excellent. And we've already had someone posting. So, and asking if we prefer chat or Q&A. Gosh, I don't know. Do we, Lauren? Do we have a preference?
No preference. I think if you do it in the chat, everyone can see your question. If you do it in the Q&A, we'll just see it. So we'll read them back either way when we're talking about them.
Oh, interesting. Well, if you're comfortable doing it in the chat, probably everyone would enjoy seeing your questions in addition to hearing the answers, but either is fine. And so with that brief introduction, I'm going to allow Yusuf to launch us into the first part of our dialogue, and we'll see where we go.
Well, we'll start with circling back on something you were mentioning, Dave, and we're not even through January yet, and there's so much to think about, so much that we've been hearing about, whether it's on the news or wherever. We wanted to have a poll here, and we've got some buzzwords on this slide. You can see inflation taking centerpiece here, and we'll be talking about inflation as we go through, but we're going to launch a poll here and just try to get a sense of which of these buzzwords might be height of mind for you. So we've got the poll launched. Thank you, Lauren. And you can see there are a number of things you can select from, things that have been grabbing headlines: inflation, interest rates, policy changes, supply chain issues, Omicron. Can't do anything these days without talking about COVID. It's dominated everything for the past couple of years, and some other related words as we go through.
And if you choose something else as your answer, type your answer into the chat for us.
Yeah, please.
Oh, this is interesting to watch it as it evolves. And as soon as the poll ends, everyone will be able to see the results.
Fascinating, if unsurprising.
Inflation's still in the lead. It's almost like a horse race. We're seeing these bars moving around.
Right.
Supply chain is up there, though. Go ahead, Lauren.
Go ahead, Lauren.
I was just going to say, we've got one in the chat here. Tax law changes is another buzzword coming up, and concern about the fall of democracy, another one here in the chat. We've got quite a few participants, about 80% of our participants who have responded so far. So we'll give it maybe another 10 seconds, and then we can close it out and show the results. Stability, another one coming in through the chat. All right, I'm going to go ahead and close this out, Yusuf, and we can look through the results.
Yeah,
All right,
perfect. Let me.
everyone should be able to see those now.
Inflation, I won't say the runaway, but certainly at the top of the list, supply chain issues probably related, and then the rest. Well, we certainly got slides on inflation.
Yeah.
So
And
we'll be
interest
getting to those
rates
here
and
in a
policy
bit.
changes and all of those things.
Absolutely. Absolutely. I think we're going to do okay today.
All right.
So, you know, as Dave mentioned, we're going to have a few questions, 3 questions in particular that we're seeking to answer as we go through our presentation today. And the first, under the Invest Big subheader, would be, how did a big economy and a big market benefit your portfolio last year? So when we talk about the economy, we've been showing you pictures, graphs, charts with indicators that we track regularly in our webinars over the past couple of years. And the indicators that we have here on this slide are ones that we've discussed several times. The COVID economy has been defined in a lot of ways economically by what's happening in the job market. And so you can see the recession on this chart is indicated by this gray bar. So actually one of the shortest, if not the shortest recessions in history, but the magnitude and the impact was significant. At the onset of the pandemic, unemployment insurance claims skyrocketed more than 6 million and have since, in the intervening months, come back down to their pre-pandemic lows. Relatedly, unemployment popped up to a percentage of 14 plus and has since returned to what's actually defined as full employment. Unemployment is at less than 4%, 3.9 as of the last reading. A bit off of the pre-pandemic highs, but still in a really good spot.
And that's really, I just have to jump in. That's extraordinary. I mean, does everyone remember back in March of 2020 when unemployment claims went from 200,000 to 6 million virtually overnight? I mean, what a shock to the system. Something I've never seen in my lifetime.
Something I hope we never see again. And you can see the effect on economic output as measured by GDP here in the blue line was dramatic, sinking more than 2-3 trillion, again, as overnight as you can get with GDP. It's measured quarterly. But the snapback was almost as dramatic and almost as immediate. And the output since has been really encouraging. We're actually projected to grow in 2022. U.S. economic output is scheduled to grow at a rate of 4%. Now, the headlines paint a negative picture and say that growth is slowing from 6.5% annualized for 2021. What we would prefer to do is take a more, look at it from a different perspective. If we zoom out and look at economic growth over the past 10 years, and we have the exact same 3 variables on this chart, focusing on GDP and just continuing the conversation from the last slide, the average annual growth rate for the past 10 years was exactly 4%. And so although there are lots of things to still be concerned about in the economy, in financial markets, with respect to COVID as a global health issue, from an economic standpoint, we have reasons to feel encouraged. This is COVID, this dip here on the right-hand side of the chart. But where it seems like if you were to map a trend line over GDP, that we're back on track. And the same could be said about the unemployment rate, again, in a great place at less than 4%, and unemployment insurance claims. And so we found that, again, not to diminish the significance of any of the issues that we're facing at this time, but there are also reasons to be encouraged, and we find those reasons to be more easily appreciable if we zoom out and look at things from a broader perspective. And so as a related point, we wanted to take a look at how our portfolio has performed with respect to the last 2 years. And so if we focus on performance since things bottomed out in markets back in March of 2020, our portfolio, as indicated by the purple line here, has doubled in value, grown by more than 100%, and is 5 percentage points ahead of the S&P, which is not actually an appropriate benchmark against which to measure our performance. The S&P 500 focuses on U.S. large company stocks, whereas our portfolio is a global portfolio. But folks always ask how we're doing against the S&P, so we thought we'd share. Gratified to see these results, and even more gratified to see that when you compare our portfolio against the MSCI ACWI, or All Country World Index, a global index of equities, our portfolio has performed much better, ahead by 16% over the past couple of years. So always happy to know that the approach that we're taking is paying dividends in times like these where there's so much uncertainty. And I should note that these returns are through the close of market yesterday. All these charts were refreshed this morning, and so they reflect the topsy-turviness that we've been living through for the past 3-4 weeks. We think that the performance of the premiums, as we've referred to them in so many of our webinars and articles in the past, the premiums that we seek to capitalize on, the performance of those premiums is what explains the performance that we've been seeing of our portfolio relative to the indexes I just mentioned on the previous slide.
And we should just for definitional purposes, when we say premium, we're talking about that increment of return that we think is unique to the different market segments we invest in. So that we can talk about the small company premium as being that extra increment on top of the returns to the market as a whole that evidence suggests you earn by investing in small company stocks. And the same thing with value stocks, which are stocks that trade at a low price relative to their earnings or their assets.
Yeah, absolutely, Dave. And what we're trying to illustrate here with this table is if you combine the small and value premium across 3 different regional slices, look at US at the top, developed markets internationally, and emerging markets, what we've seen in each of those segments or each of those regional classes, the small and value premium when combined, when we're looking at them together, if you look at this fund, which seeks to invest in US small companies, US small value companies, relative to a large growth index, the small value premium combination relative to large growth, the extra return that you realized over the past couple of years, an additional 60% small value relative to large growth. Likewise, in developed markets, an additional almost 30%. And the same being true even in developing markets, emerging markets around the world, a difference of 47% extra return you could capture by being in small and value relative to large and growth. Now, it bears repeating also that we have both kinds of investments in our portfolio. We don't think it makes sense to tilt 100% in favor of small and value. Diversification matters and helps to reduce the risk of the overall portfolio. And these premiums, while they are persistent and pervasive over time, don't show up every day. And so you want to make sure that your investments are well diversified. And yet, we're gratified in being able to say that our portfolio is tilted in a direction such that we can capitalize on these premiums. And we've been seeing that over the past couple of years.
So Yusuf and Dave, we've got a couple questions here that I think go really well together. We've got one here from Jack in the chat. Do you expect the value funds to continue to earn a premium over the near future? And Yusuf, with what you've been talking about, we have seen the performance of the premiums. Things have been doing really well over the last few years, minus some volatility in the last couple of days. And we have another question from Jim. Is now a good time to be investing? And if so, where? Concerned about a windfall that we should tread carefully on our current investment plan. So I feel like those two go well together.
Yeah, I'll start by saying that Jack's question is actually going to be answered. We have a slide coming up later, and we'll make sure that we emphasize that when we get there. Dave, I'll take an initial stab at is it a good time to invest? And then by all means, please jump in. The answer is yes. And if the question is where, it would be in a diversified portfolio like the one that we employ for all of our clients. No one knows where growth is coming from tomorrow or next year or in the years that follow, being well positioned to capitalize on growth now or as soon as possible allows you to capitalize on as many compounding periods or as much time to grow as possible. So investing now always makes sense. Is that if there's a need to mitigate risk in the face of volatility, we can invest a lump sum in installments, which is something that we often do. It's a technique known as dollar cost averaging to try to smooth out your entry point into the market and mitigate the risk of daily movements that can be pretty scary. Dave, what would you add?
First of all, I agree with all of that, of course. The only thing I would add is that the short answer about small and value, or maybe the question was about value in particular. The short answer about value is that this is not only a really good time to invest, but we think that value has a lot of room to go for economic reasons that we'll talk about in more detail in a couple of minutes.
And so that's the end of the first segment. We're pivoting now to the second question. Kind of a be big was the bucket that we had used here, but will COVID be a big threat or a big fizzle in the coming year in terms of how it affects your portfolio? So if we look at Omicron, it's certainly dominated the headlines, and it's just staggering. I mean, to look at the images, I know that these are not made up numbers, but to say out loud that over 1 million people contracted COVID in a day, within the last month or so, is just surreal. And yet, these are the facts. These are the numbers. You can see the scale here on the left, daily cases, increments of a couple 100,000 each. And then we're looking at the last 2 years. You can see the onset of the pandemic in daily cases, Delta here, and then moving through the end of last year and into this year, here's Omicron. And we're thankfully able to see that there's been what's looking like a dramatic drop in daily cases. It feels like, and the news has been, these charts are a couple of weeks old. We got them from the New York Times. It seems like Omicron has peaked. And if it hasn't peaked, in a certain region, then hopefully it's near the peak. But what's interesting to note is that Omicron seems to be significantly milder, which is encouraging as well. And so although the cases have been dramatically higher, the case numbers, always encouraging to see that some of the serious measures in terms of impact, hospitalizations and death, not following the same trajectory, which gives us hope going forward.
I know, that's really just amazing that Omicron cases peaked at 3 times the Delta level, and yet the deaths are only at half the level. So that's vastly more infectious and not nearly, and much, much less deadly. I mean, not to minimize the fact that people are still dying, but much, much less deadly than Delta, which hopefully is a trend for the future.
Yeah, I mean, things are getting better in measurable ways. Now, in terms of how markets may have been responding to Omicron, well, we can't say that there haven't been some scary ups and downs over the past couple of months. But if we look at the space of time that overlaps with Omicron's rise, what we can see is that our portfolio, thankfully, has performed better than the same 2 benchmarks that I mentioned a few slides ago. Again, the S&P indicated by the orange line over the past 7 weeks, down 3%. Likewise, for the All Country World Index, down 3%, whereas we see the stocks in our portfolio up 2% over the past 7 weeks. And so gratified that the portfolio has done well in the face of this particular part of what COVID has been throwing at us.
And small in value, as you're about to show us, Yusuf, was a non-trivial part of that.
Absolutely. Absolutely. So, if not COVID, then what might serve as a headwind to growth? Couldn't help but include this image when we were putting this slide together. What could serve as a headwind? And I'll give away the punchline. We're going to be talking about inflation over the next few slides here. Lauren, I think we have another poll here to try to gauge our attendees' sentiments. Can we launch that? So here we're asking you to do a would you rather. Given that inflation is the topic that's dominating headlines, would you rather experience markets continuing to rise, but inflation remaining high, or just have inflation be wrangled, under control, but maybe see markets tumble or take a bit of a dip? Okay, answers coming in.
While you were all answering that, prior to COVID, you may recall that back in 2017, 2018, the Federal Reserve had begun to raise short-term interest rates. Yusuf has a chart in a moment that will actually show that period. And when they first started, the market had what the headlines called but it was a taper. It was a taper tantrum because the Fed was tapering its purchase of bonds and beginning to raise rates, and they called it tapering, and the markets didn't like it, so it was called a taper tantrum. Now, these are often short-term reactions that fade, but part of the reason we're asking this question is because if and when the Fed eases back on its asset purchases and starts raising short-term interest rates, we might see another taper tantrum, at least in the short run.
And Dave, we might already be seeing it. It's no secret the Fed is meeting now, and maybe offering guidance here in the near term that the first interest rate increase is coming up in March. I'm stealing my own thunder because we have that slide coming up. But in looking at the poll results, we've got 30 responses, and it's a 2-to-1 split. Out of every trio of attendees, 2 would prefer to see markets rise, inflation be damned, and the other third saying, well, maybe it would be better if inflation was brought under control. Interesting. All righty.
And we
Moving
did,
into
Yusuf
it.
and
Go ahead.
Dave, this may come up in your slides, but we did have a question about quantitative easing. Will or has quantitative easing, or QE, ended?
We will certainly get to that as we go through. So the chart that we have here is showing the trajectory of the inflation rate. So measuring the amount by which prices have increased over the past 12 months. And we're looking at a period of time spanning almost 2 years. We're looking at things from the beginning of April through the end of last month. And you can see inflation is measured by CPI, the Consumer Price Index, that rate growing to 7% as of the last reading. And the core in CPI, when you remove volatile items like food prices and energy, a little bit less dramatic, but still a significant increase in the rate over the past couple of years. Core CPI up to 5.5%.
Before we get too deep into it, Yusuf, we had one question come in on the poll. Dave, how would you answer the poll question?
Honestly, I would, as an investor, I would probably be okay with a little bit higher inflation, and if the markets were still strong and rising. Interestingly, if you look at the history, now I don't mean to get off on too much of a tangent, but if you look at the history of inflation and stock markets over the last 50, 60 years, what you find is that stock prices tend to impound the effects of inflation. In other words, inflation doesn't necessarily mean stock returns are going to be low, especially if companies have pricing power. It turns out that a lot of companies are able to raise prices for their goods and services in line with inflation and continue to grow and continue to prosper. So we've had periods with higher inflation where the market continued to do well. They're not necessarily incompatible. As is always the case, it's usually a shock or an unexpected change in any variable that can negatively impact the stock market. But, if you have a period of a little bit higher inflation, the stocks can often weather that just fine. And so if someone's invested solely in bank CDs or something, they're not going to be happy with inflation, and that's something that's a non-trivial consideration. But the other thing about inflation is that, we'll talk more about this, I guess, in the coming slides, but some of the inflation is coming from the dislocations of the pandemic and the supply chain dislocations. And certainly based on, when I was studying economics 35 years ago, and back then, if we talked about anything like 0% in interest rates or 3.9% unemployment, or anything like the Federal Reserve's interventions, the models back then would have said we'd be in hyperinflation territory. And the reality is that some of this is dislocations due to supply chain interruptions. Some of this is undoubtedly due to extraordinary measures on the part of government, additional multi-trillion-dollar spending programs from the federal government and huge monetary support programs from the Federal Reserve. That's undoubtedly contributed. But, some of it is the low unemployment rate. Some of it is wage inflation. And considering the fact that wages have lagged for so long, giving workers a chance to get a little boost in their wages might not be a bad thing from the standpoint of social comity, social peace within our country. Maybe it reduces the gap between lower income and higher income a bit. So there could be some social benefits from a little bit more inflation than we've been accustomed to. But I do think that if it stays at this level, the Fed is definitely going to get more aggressive. Anyway, I'll turn it back over to Yusuf on that note.
No, certainly. I mean, I just had this slide pulled up, Dave, and you covered the notes that we wanted to observe here beautifully. I mean, here's that significant dislocation that you mentioned, and we had it on a previous slide, and here's inflation kind of following suit, rising here with the purple line just after. And then you can see the federal funds rate, which is the baseline interest rate that the Federal Reserve manipulates when they raise rates. It had been coming up for a couple of years, as you mentioned, flattened, and then with the pandemic, the Fed slashed rates to zero as part of their policy in trying to help stimulate or save the economy, really, from ruin. And those rates have remained at zero since, but not for long. So before we look forward, we should look backward just to gain a sense of how the Fed has done things like this before. I love this chart because it tells a really rich story. Now you can really call me an economist because if there's someone who can look at a chart like this and fall in love with it and see a rich story, you must be a dismal scientist. Anyhow, recessions indicated by the gray bars over the past 40 years. In orange is the federal funds rate. Here it is at zero in the present day. Here it is at 20% in the early 80s. And why was it so high? Because the chairman of the Fed at that time, Paul Volcker, had taken on the task of slaying the dragon of inflation. And so inflation up here at a scary 15%, you want to talk about hyperinflation, 15% there. And so Volcker launched an initiative to tame inflation and raise the interest rate here to slow things down in the economy and bring the rate at which prices were increasing down, and succeeded.
I think the phrase that he was using was break the back of inflation.
Break the back, yes, exactly. And one could argue, I think with reasonable confidence, that was achieved. The inflation rate down here at about 3% by the mid 80s. And then hovering somewhere between 3 and 6%, with maybe some years of actually negative inflation after the financial crisis in 2008 and 2009. But there's a trend line that you can see here. Now, the Federal Reserve's dual mandate is to have full employment and keep inflation at about 2%. You could say that they've been managing that dual mandate quite well over the past 35, 40 years. And one of the tools they use is to raise interest rates. As I said just a moment ago, when the economy needs to be cooled off, and that brings the inflation rate down. And likewise, when the economy needs to be stimulated, they bring rates down, and that allows for easier movement in markets, cheaper movement in markets and can stimulate growth. Before we go on to looking at things on a forward-looking basis, I'll make one more comment here, and then Dave, I'll ask you to come in if you have more to share. But the Fed has raised rates every time inflation has bumped up over the past 40 years and successfully managed to see inflation come down directly after. And so it's a strong track record. And in the most recent instance of rate increases, we saw the Fed raise rates by about 1/4 point every 3 months over the course of a couple of years to go from 0 to about 2.5. And based on what they've shared thus far, I think we can expect similar inflation rate hikes in the coming years. But before we go on, Dave, what might you add for this slide here?
Well, I mean, one of the things I'll add is that the Federal Reserve is always trying to act with finesse, but that's like saying, you know, that you're steaming across the North Atlantic in the QE2 cruise ship, and you're trying to maneuver with finesse. I mean, it does, you know, a cruise ship does not turn on a dime, and the economy doesn't either. And so the Fed tends to almost inevitably, in many cases, wait too long or react too strongly. And this is one thing that Jay Powell is really trying to avoid. He's not unmindful of this fact. But I'd invite you to look at this chart again. And again, the orange is the Fed funds rate under the control of the Fed, and the blue is the inflation rate, and the gray represents periods of recession. Now, I think you should, starting back in 1982, you should note that every recession was preceded by a spike in the federal funds rate. And in every case, at least through the mid 90s. And what you had was, you know, the Federal Reserve spiked interest rates in 1981 and sent the economy into a very steep, although fortunately short recession. And then they spiked interest rates in the early 90s, and we had a brief recession. And every time rates have gone up in this image, it's been followed by a recession. So this is the dilemma. This chart captures the dilemma that Chairman Jay Powell of the Federal Reserve is struggling with, and why he speaks so carefully when he's testifying before Congress or otherwise speaking in public, is that he's not unmindful of what you're seeing on this chart. He knows that as they begin to raise rates, which they've already indicated they're going to do, they may increase. You know, they talked about doing it 3 times. They may increase it more, but he's not unmindful of this chart. He knows that if they overshoot the market, it's going to send the economy into another recession, and that they don't want to do that. So they're attempting to do what very few Federal Reserve chairs have succeeded in doing in the past, and that is to raise rates enough to cool the rate of inflation without sending the economy into a recession. And we all obviously have our fingers crossed, and we're rooting for Chairman Powell to get it right.
It's a crazy good image, Dave, just thinking about, Fed Chair Powell trying to steer a $23 trillion boat. If we think about the economy, it's a big boat and hard to manage. And as we said, the Fed is meeting right now. And so we'll be interested to hear what the report is coming out of that meeting. But coming into today, the Fed had recently said it would keep rates near zero until we are confident the economy has weathered recent events and is on track to achieve its maximum employment, check, and price stability goals. And there's, careful word choice around inflation. And seeing as the rate is as high as it is, and it's been dominating headlines for 6-7 months, the Fed is now indicating that it's time to start doing things differently. And so back to the question that Jack asked earlier about tapering purchases, Fed has already been slowing down the purchases of bonds and pumping money into the economy. So tapering is nearing its end, and the signaling has been that the signaling to this point has been that there will at least be 3 rate hikes. Recent expectations have evolved markets may be expecting 4 hikes this year, and expecting those hikes to be incremental, 1/4 of a percentage point every few months, and then seeing what things look like before moving on.
Yeah, and when it comes to QE, which is the bond buying that Jack was referring to, there's 3 versions of tapering. And one is you stop buying more bonds every month or every quarter, or they were doing it on a monthly basis. You stop buying additional bonds every month in order to drive up bond prices, and which it's like a teeter-totter. When you drive up bond prices, it drives down yields. And so if you're trying to keep interest rates as set in the bond market low, you want to buy a lot of bonds, which drives up the price and drives down the yield, which is to say the interest rate. Anyway, the 3 forms of tapering are: you can stop buying additional bonds and just roll over the existing bonds. So when a bond matures, you just replace it. You don't buy additional bonds. You just replace what was already on your books. That's the mildest version. And then the second version of tapering your bond purchases, your quantitative easing, I should say, is that as the bonds on your books mature, you don't replace them. And so you let your bond holdings just slowly begin to diminish as bonds mature and the cash gets paid out. The third and most extreme form would be if the Fed actually started actively selling bonds from its portfolio, and that would actually drive prices down and drive rates up. And so that's like the barbell. That's like the mirror image of the aggressive QE, where you're buying bonds to drive up the price and rates down. If you're actively selling bonds, you're driving the price of bonds in the market down, and you're actively driving interest rates up. Right now, they're more living in that first stage, the second stage, where I think they're at the point again where they're allowing things to mature, but they're not actively selling anything.
So Yusuf,
Go ahead.
Quick question for you here that I actually think is answered by your bullet points, but in case you want to add any more, it seems the Fed has not moved the rate in more than 2 years. Is this driven more by politics or economics, and how do we forecast?
Yeah, I mean, so the Fed had said they were going to change their approach. Dave talked about how the Fed had maybe been a little quick on the trigger in a response to prior recessions or raising rates. And Fed Chair Powell had said, we're going to let things run a little bit, before we start taking action here. So I think the 2-year window that's being observed was, the Fed saying, let's see what happens before we start actively manipulating interest rates. Until the criteria were met, and really it's about full employment from my perspective. Dave, if you have a different take on this, by all means. But since we're at full employment and inflation is starting to get pretty high, or relatively high as related to the last 10, 20 years, now it's time to start raising rates. And then as we promised, there was another question about value stocks, and whether or not now is a good time to be getting into value stocks. It's been a good time for the past couple of years. We'll show a couple more charts. And thus far this year, value has done well. And the reason is lower interest rates favor growth stocks, whereas higher interest rates favor value stocks. And so as rates rise, and they have nowhere to go but up, we think that sets the table nicely for value stocks. We have some projections about value stocks relative to growth stocks. These are Research Associates 10-year projections going forward, and the annualized returns you can expect, U.S., non-U.S., emerging markets, the projections favor value. And it's really just about the math and the projections about interest rates and the circumstances in which at least one prognosticator thinks that value stocks are going to do really well. And there's economic fundamentals that back up that sentiment.
And that's really the whole point. I mean, I think most people on this webinar know that we talk a lot about the limits of projecting what's going to happen in the future, and we don't think that these are going to be the actual realized returns. But this is what classic economic models of what drives prices in the market would tell us based on where we are now and where we're headed, especially with respect to rates.
And as we talk about a lot internally, and as is kind of observed about economists, they make terrible prognosticators. But economists should be good at explaining how things have happened or why things have happened. And so if we look at returns over the past couple of years, the period of time that we selected here overlaps directly with the rise of inflation. So since the beginning of April 2020 through yesterday, the best performing investments in our portfolio, save for two, have been value, be they international small, international large, or US large, US small. Value stocks have done incredibly well over the past, almost 2 years. So we're gratified to see those results, and they're results that make sense given what we've been seeing in markets and in the economy. And even if we look at year to date, if you look at our portfolio's performance, again, in purple, year to date, almost down 4%. And yet, if we look at the All Country World Index, down 7%, the S&P down nearly 9%, again, through yesterday. Now, the S&P is tilted towards those growth stocks. There are 5 companies that make up an outsized proportion, I think 25% at a recent measure: Apple, Facebook, Amazon, Alphabet, Microsoft. Those
Netflix.
Companies, Netflix, yeah, thank you. Tesla, I would imagine you could throw there as well. Those companies take up an outsized proportion, but they're all recognized as growth stocks. And so seeing the performance here, again, unsurprising, just given the environment, and gratified to see that our portfolio was holding up pretty well in spite of all the volatility and the uncertainty about what's to come.
So Yusuf, before you move on, because you just brought it up, can you just give us a quick refresher on the difference between value stocks and growth stocks?
Sure. Dave mentioned it earlier. I'll reiterate. Value stocks, if you were to take 2 companies that did the exact same thing, right? Coke and Pepsi, for example, and one was priced relatively cheaply relative to the other, even though they had the same, if we imagine they had the same kind of access to factories, resources, they produced the exact same amount of soda every year, et cetera, but one stock was priced more cheaply than the other. You'd want to buy the one priced more cheaply because there's more value. You get more bang for your buck by investing your dollars there and hopefully capitalizing on the upside potential rather than buying the more expensive stock and then having more work to do to make the same kinds of returns on a forward-going basis. So what we seek to do with the value premium is buy stocks that are priced relatively cheaply relative to their counterparts and then capitalize on that value on the upswing. So that's it for segment 2, unless we have any other questions. On to the third big question, Lauren. Take it away.
All right. I think this next one is still you, Yusuf. Next slide. But then it jumps into mine.
So I will do you the favor of reading the question. Will we see any big moves from the Biden administration in 2022?
Sorry, Yusuf, this is the one I was talking about, this slide.
There you are.
To go through this one?
Yeah, so I think we can share it. I mean, we've talked about, Omicron. We'll certainly continue to watch it. As it relates to inflation, it'll be interesting to see what the May reading is. In May of 2021, the inflation rate is when it popped up to about 5%. That's when it started making headlines. Note that it's a 12-month. It's an observation of the rate as it increases over the past 12 months. So it'll be interesting to see how the rate has grown over the year following that initial May 2021 reading when things popped up to a relatively higher rate. So we'll be watching that. We've talked through the interest rate hikes coming through from the Fed. And then, it's never too early to start thinking about election season. Midterms are only 10 months away, and we'll see whether or not that deadline drives action in the part of legislation coming down the pike. So what's coming from Washington?
Thank you, Yusuf. So this is Nora at 3 days old. She's going to be 5 months old next week, which is crazy, but the picture seemed perfect. She's saying, we don't know. What's coming from Washington? Who knows? And so if we move to the next slide, the Build Back Better bill is something that you've probably heard a lot about, or if you don't know the name of it, you've heard about tax law changes coming, policy changes. And it was something in late 2021 that looked really to be a sure bet, something that was going to pass, probably going to pass, down to the wire end of the year. And then it took an abrupt turn and went to a standstill, really from Senator Joe Manchin and the child tax credit. He has put his foot down saying that it was just simply too expensive of a provision in this Build Back Better bill that is, was as currently proposed a $2.2 trillion bill, but really looks to be DOA right now and is by all expert opinions not going to ever pass in its current format. That being said, President Biden and a lot of our legislators have come out saying they are willing to break it down into smaller chunks and go back to the floor and try to get some bipartisan support for various measures within the bill to hopefully get some things passed instead of just letting it go. Yesterday I was reading a piece. House Majority Leader Hoyer said he doesn't think Build Back Better is completely DOA. He thinks that he's very much on board with getting pieces passed. And we know Mitt Romney has been a big supporter of the child tax credit. His initial proposal in February of 2021 was to make it permanent, make the increases permanent. And so what happened with the child tax credit, before the Tax Cut and Jobs Act of 2017, the child tax credit was $1,000 per child under the age of 16. The Tax Cut and Jobs Act of 2017 from the President Trump administration doubled that. And then last year during the pandemic, it was further increased to $3,000 per child under age 17. So then including 16-year-olds with an additional $600 a year for those children under 6 at the end of the year. And what was even more improved was that this credit was changed to be a monthly advance payment to families who qualify. So these families were getting $300 to $320 a month in advance before they ever had to file their tax return, which is usually where you get the benefit of these credits when you actually file your return for the prior year. And so it was a huge benefit to many families during the pandemic. There are some sources saying that it was able to cut child poverty by half to a third to a half. And so, it was a big benefit. So it makes sense why there are a lot of people who are really supporting increasing it, especially while we're still going through such tough times.
And I have to say that it's surprising to me that Joe Manchin was so specifically opposed to this one, because from everything I've read, the benefits of the child tax credit flowed extensively to the citizens of West Virginia. I mean, they were huge. I think West Virginia was as big a beneficiary on a per capita basis as any state in the nation.
Yes, agreed. Thank you. So Yusuf, for the next slide, we'll move into, the current, as I mentioned, the current bill as it stands is looking like there's no chance that it will ever pass in its current format. But we can look at what wasn't included that we were expecting and what was included that we might still expect to see later this year in those broken down chunks. And so it was just under a year ago that I was sitting in a similar chair giving a presentation about tax increases that were coming that we were going to need to plan for. Nothing has happened with those yet. But some of the things that we are not expecting to see in whatever the final version of Build Back Better is, or the final versions, as we think it's really going to unfold in chunks throughout the year. We haven't seen that increase in the top marginal tax bracket back to 39.6% yet, and I'll touch on that in a moment. We no longer see that estate tax exemption reduction yet. We talked about the increase in the capital gains bracket being up to 39.6% if your income was over $1 million. That's been removed. Qualified business income deduction, so QBI deduction if you own or run a business and have income from that business, was talking about being limited by income. That's been removed. And the child and dependent care credit, which is different from the child tax credit. This is a credit for expenses that you actually pay for care for your children or dependents. That is not going to be extended at much higher levels. So that will revert back to the previous levels and has already so far because those extensions did cease at the end of 2021. So back to those first two bullet points, the planning and thinking that we did around these tax law changes last year was not for nothing. The top marginal tax bracket and the estate tax exemption are already set to go back to their prior levels when the Tax Cut and Jobs Act sunsets at the end of 2026. So the plan right now is that top marginal tax bracket will go back to 39.6. It's not new. It was something that was already in place before 2017. And the estate tax exemption, which for 2022 is about $12 million per person, is set to go back to half of that per person at the end of the Tax Cut and Jobs Act sunset. So the planning and thinking that we've been doing around these changes, thinking maybe it was going to happen in 2021, was not for naught. There is plenty of planning we'll be doing around those two specifics and anything else that's sunsetting coming in the coming years before they sunset. But we're not expecting to see these this year. So what are we expecting to see, or what might we see? In the version of the bill as it stands, which again sounds like it's just going to be chopped up and taken back to the floor piecemeal. That child tax credit, I think that's a big one. It's been, we already talked about it, was the big stumbling block. It's been big in the headlines. It has been a huge help to different Americans. And so I think that will continue to be a source of conversation and hopefully something that is acted on, whether it's extended permanently, extended for another year, or altered. Dan, we'll talk about Roth accounts here in a minute. And so speaking of that, backdoor Roth contributions or backdoor Roth conversion. So a backdoor Roth conversion is when you earn too much money to contribute directly to a Roth, and you earn too much money to contribute a deductible contribution to an IRA. And so you make a non-deductible contribution to an IRA, and then you immediately convert it to a Roth IRA. And because you put after-tax money into an IRA, you don't owe taxes on conversion to Roth. So really it's a backdoor way of making a Roth contribution. And this has also been a big one that has been talked about being eliminated as a possibility for anyone going forward. And so that's something that we might see come up. And if it is, it's something that we'll have to plan accordingly when the time comes. One of the things that we've heard a lot about is whether or not these tax law changes could be retroactive to the beginning of 2022, because these changes were planned to go into effect at the end of 2021 and be in effect for all of 2022 if the original bill had passed as intended. And so it is absolutely legal and possible that these changes could be made retroactive. It hasn't been done since I believe the first time it was done was in the 1800s, the very first time, and it hasn't been done in a long time. So the likelihood from the experts is that it likely will not be retroactive. And I think we won't get into the details because we don't have time, but if they retroactively got rid of backdoor Roth contributions and people have already completed them in 2022, it would be a huge mess. And so we don't think it will be retroactive, but of course we don't get to make that decision. So we'll keep an eye on it. Another thing that was proposed was to get rid of all Roth conversions for those in the top marginal tax bracket starting about 10 years from now. So that's something that we might see come up in this. And really that was a budgetary input in there to help with the finances of what the bill looked like, because if there is a limit put on when you can do those Roth conversions, people in those top tax brackets might do those conversions over the next 10 years, and that can count as income, because they would pay taxes, high taxes on those conversions if they decided to do them. A big one for our Californians, or really anyone in a high income tax state and anyone who pays more than $10,000 of state income taxes a year, is that the SALT, that's the state and local tax limit, that's a deduction that you take on your itemized deduction. Right now it's limited to $10,000 per couple. There have been a lot of talks about increasing that, probably not getting rid of the limit completely, but increasing it up to $80,000 a year, which would help a lot of people with with their itemized deductions. It would also reduce some of the income, some of the revenue that is expected to be generated from these income tax increases. So then we have a surtax on the ultra high net worth. So if there's income over 10 million, QSBS is qualified small business stock. So there are rules that if you have small business stock from a very early startup and you sell it after 5 years of holding, you can exclude up to $10 million of gain. It's a huge benefit. There may be some limitations we'll see. And if you want to start a really fun conversation, and by that I mean argument or debate at your next family event, talk about cryptocurrency and the wash sale rule, especially if you have some family investing in cryptocurrency. Currently, the rule does not exist. So you could sell your cryptocurrency at a loss, buy it again the very next day or the next minute because it trades constantly, and you would get to take that loss on your tax return. And this is unlike your traditional investments. So in brokerage accounts, if you sell a position for a loss, you have to wait 30 days before buying something of similar status. Otherwise, you don't get to take that loss on your tax return against your other income. So I have a question that came in here, the backdoor Roth conversion or backdoor Roth contribution scenario, to go over it again. So a backdoor Roth contribution is when, and there are some nuances here. So we can talk about this specifically with anyone who is interested if it doesn't get eliminated, but you have to have no other IRA balances because any distributions from IRAs are considered to be pro rata. So let's say you have no IRA balances, you contribute
and
the
Lauren,
full.
I'm going to interrupt you just long enough to say, the only reason you would care about looking for a backdoor is that above certain income thresholds, you're not allowed to make a contribution to a Roth otherwise. So this is a way of sneaking in.
Exactly. So if that situation applies to you, you make a contribution to your IRA, it's not deductible to you on your tax return. So you're putting after-tax dollars in there. And then you immediately, or after a few days, you take that money and you convert it to a Roth IRA. Usually when you take money out of an IRA to put it into a Roth, so a traditional Roth conversion, you pay taxes on the amount that comes out of the IRA because it's pre-tax, because you have previously received a tax deduction. But in this case, because you're putting after-tax dollars into that IRA and you've got no tax deduction, you can convert those to a Roth for free. And then that money grows in the Roth forever. So again, as Dave mentioned, it really only applies in certain cases where you make too much money to convert to a Roth. You still have earned income because you can't convert to an IRA if you don't have earned income, and you have no other IRA balances. So there's nothing that would muck up that conversion from traditional to Roth. And so again, this is something that they're talking about getting rid of, that I think we are probably likely to see, if anything gets through from this Build Back Better Act this year. But if they don't get rid of it, it's something that would then stay for those for whom it applies. And finally, on the next piece here, there were some original retirement implications in the very early versions of the Build Back Better Act that we haven't seen much of recently. And so there is some talk of maybe Secure Act 2.0 coming later this year. And so you'll recall the Secure Act was the one that delayed RMD age, required minimum distribution age to 72, allowed people to contribute to retirement IRAs after age 70 and a half if they were still working. So all focused on retirement, setting everyone up for a more secure retirement. So there is talk that maybe Secure Act 2.0 will be a separate piece of legislation that we will see come sometime in 2022. So I guess my summary is back to that picture of Nora. We don't know what's coming. I don't know that the legislators know what's coming yet. They have everyone has their desires of pieces of this Build Back Better bill that they would really like to see get through. Some people have pieces that they do not want to see get through and are putting their foot down. And so our message is that we're paying attention. We're always paying attention to what's happening. And as things unfold throughout the year, we think it's really going to be piecemeal. And so we'll keep an eye on what is coming, and we'll keep all of you updated. And if anything applies directly to anyone, we'll be reaching out proactively to say what planning we think needs to be done. And so I did see here, I know we're a bit over time, a couple minutes over time, but we do have a couple questions here that have come in. Dave and Yusuf, if you want to comment on, are there what are our thoughts about the potential conflicts with Russia, the Ukraine, impact on the markets, anything that we expect there?
Dave, I would defer. Yeah, go ahead.
Yeah, I was just going to say, one of the things, there's actually, this is a question that's been examined quite a bit. What are the results of global conflicts, including military conflicts on the markets? And it goes back to something I said earlier. The markets tend to react to surprises. And so if we wake up tomorrow morning and Russia has sent all 125,000 troops that were massed at the Ukrainian border into an actual ground invasion, that would be a shock. That would be a surprise. And, and the markets would undoubtedly go down. But the other thing the evidence shows is that these things tend to be transitory. So the markets decline in the face of the heightened uncertainty that comes from the shock, and then they tend to recover quickly.
As we saw with COVID, not exactly the same set of circumstances, but a shock nonetheless. Was there another question, Lauren?
There is one more that's come in talking about headlines. The headlines have been mentioning that we've seen a 10% correction in the stock market. Is this overblown clickbait or is it partially true?
It depends on what part of the market you're looking at. If you're looking
true
at
for NASDAQ for sure, right?
True for NASDAQ is almost true for the S&P, depending on the period of time you're looking at. But yeah, parts of the market have been in correction, and it's just been a really volatile, last few months. And really, we saw most of the growth that we experienced in 2021 in the first half of the year, and since the summer, things have just kind of hovered around this flat. Things have plateaued, would be a more efficient way of saying it. So, and we'd be remiss if we didn't say that corrections generally set the table for the next upswing. It's only a matter of time.
I'm not seeing any more questions here, so I think we're good.
Right. Well, this was fun. By all means, keep the questions coming. And we look forward to seeing you on the next webinar.
Indeed. And this will be recorded, or it has been recorded, and that'll be made available if you have anybody who couldn't make it but you think might be interested. You'll be getting a link to the recording this afternoon or tomorrow at the latest. So thanks for joining us. And as both Lauren and Yusuf have said, we're available to answer questions 365 days a year. So you don't have to wait for a webinar. Have a great day and a month and a great year.